All right, let's take a look at the S&P 500. Okay, we always bring you the Dow, the Nasdaq occasionally. How about the Nasdaq? The S&P 500, down 9 points at 2,428. Why are we showing you the S&P 500? There's a good reason here. It's not just that it's a broad-based indicator. Oh, no. This man, David Stockman, former budget director under President Reagan, this man says that the S&P 500 is going to fall 35%. That will be roughly the equivalent of about 800, 900 points, if I'm not mistaken. Is that correct? Oh, wait, before you launch, David, before you launch, now we're down today. Yeah. We've had a pullback today. Is this the start?
I think it'll happen any day because we're a country that's out of control.
You've been saying that
now, wait a minute.
For donkey's years.
Okay.
That's a long time.
Hey, Stuart, I could have said that in February 2000 and the market dropped by 60%. I could have said that in November 2007 and the market crashed. I could have said it, I'm old enough to remember, October 1987. Okay, markets go up on an escalator, they come down on an elevator. This is the most hideously overvalued market in history. It is trading today at 25 times, now let me finish, the $100 a share that the S&P 500 earned in the period ending in March. Now, I go back 10 years to June 2007. The S&P 500 earned $85 a share. That's 1.2% growth nominal in 10 years, and you want to pay 25 times earnings going into a world where the Fed yesterday said we're going to shrink the balance sheet by $2 trillion over the next several years, where we have a government that is in total chaos, a president they're trying to unseat, a debt ceiling that can't be raised, a tax bill that will never pass, going into all of that to say nothing of the red Ponzi in China one of these days spilling its guts all over the world economy, and you want to pay 25 times earnings for today's stock? Be my guest. This is a mania. This is a mania.
The one time when I've given you full throttle, the full ability to go ahead and make your case, you actually made a very intriguing case. I'll give you that. Okay. But the trouble is, 2 points. Yeah. You mentioned October 19th, 1987, was it?
October 87. 3 points. 3 days.
Okay.
3 points.
There was that. There was the low, the big sell-off that took us down to 6,000 on the Dow by March of 2009, as I recall.
And in 2000, we had a massive 70% sell-off on the Nasdaq 100.
I'm not that particular occasion, but in 89 and in 2009, the markets bounced back very, very quickly.
Because
why can't the same thing happen this time?
Because the Fed opened up the stimulus chute and printed money like there was no tomorrow. In 7 weeks after the Lehman bankruptcy, Bernanke doubled the size of the balance sheet from 900 to 1.8 trillion, did in 7 weeks what the Fed did in 94 years. Now, my point is they can't do it again. Okay. They're out of dry powder.
Look. Okay, I'm listening to you. Okay. And you've got all of our viewers worried stiff.
They should be. They should be. And any of them that are in the market today should get out of the market, get out of harm's way.
The script says, thanks, David, get out of here. No, that's it. That's very good. Thank you very much for joining us, David. I do appreciate it.